Hello. Um, Thanks for coming to LinkedIn Live. And I'm going to talk about the risk of a surge in inflation. So, those of you who follow me on LinkedIn know that a year ago, I was sketching the major risks that the recovery faces. So, the headwinds. And one of these risks is inflation. And now I think the conversation has changed in that inflation is now talked about where it wasn't talked about 6 months ago. And we have some numbers that suggest that inflation is potentially increasing. So this conversation is informed by a recent research paper that I posted on SSRN. And in the chat, I'll actually put a link to that paper for you. And that paper looks at the implications of a surge in inflation on asset prices. So let me kind of start this off, and I want lots of time for questions. Let me start this off by kind of going through what's the current environment and why is it that inflation risk has actually increased. So in the paper, we kind of sketch a situation. And the situation is extraordinary in that the COVID-19 crisis led to unprecedented actions by government. So it's really striking to take a look at the growth in M1 or M2 over the last year. It's literally off the chart. So that's on the monetary side. So we've gone all in on quantitative easing. And you might say, well, we had quantitative easing in the global financial crisis, and we didn't really see inflation afterwards. And that's kind of true. It is the case that inflation crossed the 5% rate in 2009, but quickly calmed down. But the scale of the QE today is much greater. So the monetary stimulus, if you want to call it that, is much more severe today. Anyways, the global financial crisis is a single event. On the other side, on the fiscal side, we've had extraordinary sort of government intervention. So the deficit in 2020, about $3.1 trillion. And the Congressional Budget Office expects that the deficit in 2021 will be over $2 trillion. Okay, so there again, there's both a monetary and fiscal reason that there could be some issues. Yesterday, of course, we had the CPI print, which was 0.6%. And predictably, um, basically people tried to brush it off. So the Council of Economic Advisors had a series of tweets that were kind of predictable. And they basically said, well, there's multiple reasons why this is a temporary phenomena. And the first reason was the so-called base rate. So you start at a low rate, and then anything that is higher looks high. I have no idea what that logic actually means. It's certainly not an excuse. A point 0.6 is a point 0.6. They also mentioned things like supply chain disruption, which it is true that there has been some disruption, but it's just unlikely to account for all of that. And then this idea of pent up demand. And that's kind of a standard thing that people talk about. Again, these are excuses. The fact is that if you look at the derivatives market, that there's a 30% probability that the average inflation rate over the next 5 years will be 3% or greater. Okay, so Think about it, that's the average rate over the next 5 years. So it is clear that expected inflation has increased. You can just look to the bond market for this too, where the long-term bond yields have gone from 0.5% to well over 1.5%. Okay, so again, this is just an increase in expected inflation. So what about the implications of this? So uh, again, my recent paper looks at the financial implications. So on the macro side, a surge in inflation is rarely good news. And let me be careful in terms of what I'm talking about here. A lot depends on the level that you start with. So if you're in a negative inflation situation, and inflation increases. So let's say you go from negative 2% to a positive 1%, which is a substantial increase. That's actually good news because deflation is often the sign of economic weakness. So in my paper, we're really careful to kind of separate out this this healthy increase in inflation from what we call an inflation surge from, let's say, an average level. So think of starting at 2%. And if we go from 2% to 5%, that is bad news. Whereas going from -1 to 2%, well, that's likely just the re-energization of the economy. Okay, so what we do in the paper is to go through and identify in the US, the UK, and Japan different episodes where inflation surges. And in the US, we have 8 episodes over the last 95 years. And one of the issues here is we haven't really seen big inflation in a long time. So many people don't remember or weren't even around in the early 1980s when inflation was out of control. So indeed, in 1970s, we had wage and price controls because inflation was such a problem. So it's really important to go back in time. So let me talk about what I mean by an inflation surge. So the method of our paper is to look at episodes. We also look at the average, but it's really important to look at the individual episodes because each episode is different. And we're at a point where the inflation rate's been hovering around 1.5% to 2% for a while. And if inflation does surge, this would qualify in terms of one of our episodes because we're starting from, let's say, the average rate. So we look at various different investments. And again, let me be clear about a few things. So what we really care about is unexpected inflation. So the surprise in inflation would characterize a surge. And a surprise in inflation is something that people often want to hedge against. So think of a natural hedging instrument like a treasury inflation protected security, a TIP. So that would provide you with some protection because the way that's designed is essentially covering your inflation risk. So what we do is we look at a number of different assets. And in my kind of preview of the paper, I said that the bottom line here is that equities get punished in inflation surges. But let's kind of go through the full set of assets here. And the set of assets kind of start with fixed income. And fixed income is very straightforward because expected inflation is already incorporated in the bond price. So think of the bond yield as an expected real return and an expected inflation. And there's also expected risk premium. So anytime inflation uh, surges, so there's a surprise, that effectively means that the yield increases, and that means prices go down. And obviously, it's more severe for longer duration bonds. So equities are more interesting. Um, so they're also long duration. So meaning that there's no fixed maturity for an equity, and the cash flows are often spread out in the far future, especially for growth stocks. So the same sort of mechanism could apply to equities, and in particular growth stocks, because the actual cash flows for those stocks often don't occur for many years. But let's think of the basic mechanism here. So a company is selling some goods and the input price goes up. Well, why is that bad news? Because you can just pass on the increases in your input costs by raising your prices of what you're selling. Well, it seems like simple that you can do that. And some firms actually can do that because they've got market power, but other firms can't do that. And and that means that it's usually the case that the profitability of companies decreases, and that leads to lower stock prices. There's an interesting tax reason too, that a positive surprise in inflation would be associated with kind of negative stock returns. It has to do with depreciation. So you buy some capital equipment, and there's an accounting expense, depreciation, that basically uh, leads to a tax deduction. But the depreciation doesn't take into account the inflation in the capital good. So effectively, you're not deducting enough to cover the replacement of the capital good, and therefore inflation acts as a tax. And again, it's kind of interesting because some firms, this really bites them. So firms that have large capital equipment expenditures, but other firms that have more intangible capital, this isn't as big of a deal. But overall, there's a negative relation. And what we do is looking across all these episodes, um, the real return, which is what we care about. So, not the nominal return. So, the nominal return is just what happens. But you need to subtract out the loss in purchasing power from the inflation surge. So, the real return on equities is negative. On an annualized basis, in inflation surges, the real return is minus 7%. So we look at a lot of other assets and asset classes in the paper, and let me sketch those before going to questions. So what about commodities? And commodities also are fairly intuitive because often commodities are the driver of inflation. So think of the inflations in the 1970s and 80s that were driven by energy prices. So commodities provide some hedging ability for unexpected inflation. But what our paper does is actually take a deep dive into the individual commodities. And what we find is that some commodities are much more effective than other commodities in providing some protection for inflation. We even look at other asset classes like real estate, which roughly holds its value in an inflation surge, and more exotic asset classes like art and wine. And we find that they also provide some ability to hedge the inflationary surge. So for me, the most interesting part of the paper is to look at active strategies. So these would be strategies perhaps based upon equity factors. So investing in value or quality or things like that. And this involves having a long portfolio and a short portfolio. And these factors actually they provide some modest level of protection. And it's not great, but it's essentially far better than just having a passive long-only equity position. And we also look at another strategy, which is a hedging strategy that's trend following. And trend following has got a very long track record of performing well when the economy tanks or the market tanks, because the trend following system is taking advantage of kind of a negative drawdown. And it also takes advantage on the other side of when the markets are booming. So we actually tested to see if these strategies provided some protection in an inflationary surge, and the answer is yes. And that's kind of interesting. So one issue here is that those strategies don't have a huge amount of capacity. So if you're a large pension plan, there's only a limited amount that you could allocate there, and you should do that. But there the capacity is limited, and other possibilities arise, such as a factor type of strategy. So that's basically my paper that details what could happen. Inflation is very complicated, very difficult to deal with. Indeed, in the paper, we also examined the components of inflation. And because inflation's different for everybody, right? So everybody's got their own basket. So it's important to look at the different components in any comprehensive analysis of inflation. And inflation just overall is really difficult to even think about because of all the adjustments that are made. So the CPI in 1983, the basket is $100, and today I think it's 273. But what does that really mean? There's all sorts of quality adjustments that go on, and and it's difficult to actually do this. Uh, think of in 1990, a Cray supercomputer cost $32 million. But like my phone, it's more powerful than over 100 of those supercomputers, and it's $1,000. Just the data in my phone. So gigabyte in 1990 cost $10,000. My phone's got 512 gigabytes. So again, these are challenges in actually doing inflation. But what moves the market generally is the overall CPI. And that's where we focus in our paper. So I encourage you to take a look at the paper. And I am kind of looking forward to some of the questions. So let me take a look at the questions that are popping up. And yeah, so Brian, an alumnus of Fuqua and an alumnus of my crypto ventures course, has got a really good question, and that is, uh, if we're looking at the inflation derivatives market, it's always important to take a look at the change. So the 30% probability of an average rate of 3% over the next 5 years, okay, that's a fact, but what was it the year before? And the year before, it was far smaller. So very few people thought that the average rate over the next 5 years would be 3%. And this is it's kind of interesting because the one thing that I think everybody agrees upon is that the risk of a higher inflation has increased. Okay, so it might be that the way you look at that is to put some probability on a scenario like a surge to 5% or 6% in inflation. So that probability has increased. And part of the reason that I wrote this paper with my colleagues at Man Group is that you need to prepare your portfolio today. So this is a fact that the risk of an inflation surge has increased. It might be that inflation doesn't surge, but you need to exercise some risk management. And that means to kind of re-examine your portfolio positioning and ask the question, well, we think that the probability of inflation crossing 5% last year was maybe 1%. This year, maybe it's 15%. So you need to look at your portfolio and look at the positioning and figure out, are you positioned to deal with that sort of risk realization? So you need to do that today. The worst possible strategy is to be reactive. After the surge happens, you start to reallocate your investments. And often when you do that, you're basically selling low and buying high. So it's better to think about this stuff now instead of waiting for a realization. The realization doesn't occur, fine. You're prepared. And you're not going to be criticized for that. Okay. So Josh, also an alum, asked, what is actual inflation? Acknowledging CPI isn't inclusive of many contemporary products and services. So it is essentially an impossible question to answer because, again, inflation depends upon the individual. So each individual has got a different basket. It is definitely the case that that the CPI, as we measure it, is closer to the basket of certain people in the population than other people in the population. That's true. But in the end, it's the CPI that's generally agreed upon as the metric that's the most relevant. So there are other sort of ways to measure inflation. So there's CPI headline. There's the core CPI that takes out certain things in the basket that are highly volatile. There is the inflation for the personal consumption expenditures, and that is the inflation that the Fed likes to focus on. There's the inflation rate for GDP. So there's many different inflation rates, and we actually did some analysis in our paper. It doesn't really matter which one you use. They're all highly correlated. So again, there's no clean answer to this question. It's difficult, but it is essentially market-driven that people look at the CPI. For example, the CPI is used for the Treasury, tips. So that's the one that people mainly focus on. The point is a good one, and I already mentioned the quality adjustments are, ad hoc at best. So there's an art to actually doing this. Okay, so there's a question from William about kind of longer term investments or instruments hit harder by inflation, and basically suggesting perhaps an options like strategy for some protection. So So let me try to address that. And one thing that I didn't really address is expected inflation. So expected inflation is important because it is incorporated into the bond yields, and I went through that. So if expected inflation changes, then that can impact the bond yields. But what is the expected inflation horizon? So is it expected inflation for April 2021? Is it expected inflation for the next 12 months? Is it expected inflation for the next 5 years or 10 years? Okay, so essentially what I'm saying is that we need to also take into account the term structure of inflation expectations. So you could have a transitory surge in inflation. And that means that inflation would go up and be a surprise, but the longer term instruments wouldn't necessarily take a large hit because people generally expect that the inflation is going to be short lived. And the long term instrument, what it cares about is the expected inflation over the entire horizon. So it might be a 10-year bond. So what's relevant is the expected inflation over the 10 years, not the next month. So it's really important to figure out in terms of if you're trying to execute a hedging type of strategy, is the inflation that we're experiencing a transitory inflation, or is it a permanent or a longer lived type of inflation? So that's really crucial in putting together any sort of hedging strategy. And it's another layer of complexity when you're dealing with inflation. We talk about inflation, but again, what is inflation in general? Like, how do we measure it? CPI or some other measure? But also, what is the horizon for inflation? That's also important. Okay, so there's a question from Anhalt, who's an alum, and talking about the asymmetric impact of COVID in different industries. And maybe we should expect a wide range of different impacts for inflation. So this is a great question, and I didn't talk about it, but in the paper, we actually have our analysis for the US for the 8 different inflation surges for different sectors. And in the main paper, we provide kind of very general sectors, but in the appendix of the paper, we take a deeper dive into 49 different industries. So this is a very important point that each company, each industry has got a beta. Uh, and the beta measures the sensitivity of the stock return to unexpected inflation. And you are correct that this depends upon the particular industry, it depends upon the particular company. So any strategy whereby you're looking at individual equities, you need to take into account their sensitivity. And and let's be careful here. And this is one of the innovations in my paper, just to try to estimate that sensitivity using all the data is going to be very difficult because as all these little changes in inflation, and there's so much noise in both inflation and the asset returns. And that's exactly why we look at these episodes. So we look at these 8 really important episodes, and you can actually, using those episodes, figure out what the betas are. So the other part of the question has to do with just kind of the change induced by COVID-19. And I agree with that also, that that this particular crisis is different than other crises, almost by definition. every crisis, every recession is different. And that's exactly why we don't just report the average. So the average is really misleading because each episode is different. So in going to individual episodes, you can kind of figure out, well, is this episode closer to episode 3 or number 4? And then take a look. Um, of course, the COVID-19 recession is very unique, and some judgment needs to be made. The other thing that I'll mention is that many of the companies that have done well in COVID-19 are the type of companies that have a lot of intangibles. And intangibles are really important to take into account, as I mentioned, in terms of the tax hit from inflation. And it's also, given what I talked about in terms of market power, that's important to take into account also. So certain companies that have market power, like Google, Facebook, Amazon, they can actually change the prices at will because they've got the power to do that due to lack of competition. So all of this needs to be taken into account in kind of designing a portfolio. Um, let's see. So David, an alum, how do we differentiate between inflation and dollar devaluation effects in equity markets? So this is a good question. And indeed, my longer presentation on the risk of unexpected inflation actually tries to disentangle what's happening. And it is true that obviously the difference in inflation in in two different countries will affect the exchange rate. And the mechanism is straightforward. It's through the interest rate differential. So another aspect of the paper that I didn't mention, it's interesting, the questions are asking me about stuff that is in the paper that I didn't have time to go through in 15 minutes. The other part of the paper has to do with kind of the synchronization. And what I mean by that is, well, it might be that one country has some inflation, but another country doesn't. So in our kind of 3-country example of the US, the UK, and inflation, the worst possible times is a situation with global inflation. So you've got, for example, a majority. So the UK and the US are having an inflation episode. And the sort of logic that I went through in terms of the sort of risks that have been created by our policymakers, well, it's not just the US. So it's other countries have actually undertaken extraordinary sort of stimulus sort of measures, both monetary and fiscal. So, so I think that the role of exchange rate will always be there. But if it's the case that this surge in inflation is not just a US phenomena, then that's especially bad news. So let's see. This is a good question from Jesse, who's a current student. Does the impact of inflation accelerate for companies more supported by cheap debt, like zombie companies? So I've talked about these zombie companies for a while. So the very low interest rates are essentially keeping many companies alive, that buying time. So the idea here is if these companies have floating rate debt, if inflation goes up, interest rates will also go up. It'll make it very difficult for these companies to meet their obligations, and it will accelerate their demise. And I guess a subtle issue here is, well, maybe that's a good thing. And I actually agree with that. I know it's tough, but it's far better for resources to be redeployed into other sectors that are much more profitable, because when you do that, it leads to higher GDP growth. So if you've got this zombie firm that's barely getting by, it's not really contributing that much to GDP. Ideally, what we want are those productive resources, both the capital and the labor, deployed to companies that have got great growth potential. And this is doubly important because the size of the debt that we've racked up is really staggering. So it's about $250,000 per taxpayer right now in the US. That's the government debt. And that doesn't include unfunded obligations. So it's really difficult to get out of that hole. And you could raise taxes, and we know that that is rarely associated with economic growth. You could inflate, and ideally we want to avoid that. But the other way out is just growth. So if we have robust growth, then that provides extra tax revenue by definition, and allows us to pay down that debt. So maybe this, I guess the point of the question is that there could be some hidden benefits, and I take that as a point well taken. But overall, you need to look at all of the benefits versus all of the costs. And inflation, again, historically, when you start from a level like where we are, is just it's just bad news. It's bad news for equities. It's bad news for fixed income. If you're a 60-40 investor, like many people are, 60% in equities, 40% in treasuries, it's bad news. If you're fortunate enough to have a hedging program, that is going to be valuable for you if inflation does surge. But it's also the case that if you look at economic activity, when there's a surge in inflation, there's often a decrease in economic activity or recessions. And we sketch that also in the paper. So I am kind of running out of time at this point, and there's so many incredible questions. So right now, I guess I'm going to have to wrap up. I've gone over time already, but look, we're going to capture all your questions, and again, follow me on LinkedIn, where I routinely post on these topics, and I'll try to get back to you with your questions. So, as you know, we do this all the time at Fuqua, and next Wednesday we've got another LinkedIn Live, and my colleague Scott is going to talk about the implications of the Biden tax plan. So that should be really interested and actually synergistic with what I've talked about today. So thank you.